All right, so today we're going to talk about inventory, and the next exam will deal exclusively with inventory. It is, you're going to learn more systems than you did in intro. You're going to learn that there's a perpetual system and a periodic system, and the differences between those, the one that's more prevalently used. We're also going to talk about the costs that are included in inventory, in the actual account, in the value we place for inventory. And we're also going to talk about how the inventory account and the cost of goods sold account are related. We're also going to be talking about LIFO versus FIFO, of course, how companies can use one system internally, report in a different system externally. And we'll also be talking about reducing inventory through an impairment called inventory write-down, or sometimes it's called inventory impairment. Basically, we're employing that valuation that inventory should be at the lower of cost or market, or the lower of cost or net realizable value, depending on which inventory system you're using. So this chapter to me is difficult in terms of the number of systems, the number of alternatives, the number of mechanisms that we have to deal with. And so again, you really want to keep a close eye on the process, on the sort of overall narrative, and not just jump into the details. You really need to understand what all these things are doing and why we're doing them, in order to sort of maintain an organized schematic for you to follow when you're learning all these different journal entries. So let's jump into the notes. These are the notes that are on the chapter 8 content area online. And that's where you can find them and download them, print them and annotize them, or read them as you wish. So, so basically, of course, we have our objectives, but I want to jump into some of the, just jump straight into the stuff so we don't waste a whole lot of time. The first thing that we want to understand is that, the primary definition of inventory, because, you could think of inventory as just a stock of things, and companies stock supplies. Rental car companies stock cars, but that and someone might reference that as their inventory of rental cars. But in a financial reporting sense, that does not classify as inventory, because they are assets held for sale. And rental cars are not held for sale. Like an office company that has supplies is not holding their inventory of supplies for sale. So from a financial reporting perspective, that definition doesn't fly. And these are things we're selling in the ordinary course of business. So this would be a reference to the operating activities of the business, which we visited a few times before, where we're talking about, well, are these the central ongoing operations of the company? And, of course, we could either have, we could have operations where we are manufacturing the item and that we're manufacturing inventory. And in those situations, we have different types of inventory. We have raw materials, work in process, finished goods. And all three of those items would be disclosed as values that would be included in the company's inventory. For merchandising retail firms, your typical store that we patron a lot, it would just be their merchandise inventory. If we're talking about a company that involves itself in several or discrete, that is unique, long-term projects, thinking like maybe commercial real estate ventures, defense contractors, projects where we are using a substantial amount of time to produce one unit, that could be called construction in progress. And that's something that you'll visit in Intermediate 2, related to the revenue recognition of those sorts of contracts. Like I alluded to at the start of the video, there are two systems You're likely more familiar with the perpetual system, which is typically taught in intro to financial accounting, but there also exists a periodic system. The perpetual system, now with our extremely quick data processing and ability to store massive amounts of data, technological advancements over the past 3 decades, has become sort of the most used, the most widely used and popular system. Periodic is a bit of an antiquated system and doesn't provide as much up-to-date information on our inventory analysis. It might be used by smaller companies, companies with perhaps smaller volume of sales, but perpetual would certainly be used by large companies with low margin, high volume sales, where they're just making sales transaction consistently all the time. So let's talk about the two a little bit more directly. Under the perpetual system, the inventory account is continuously updated, and along with the cost of goods sold. So the entry is, debit inventory and credit cost of goods, debit inventory and credit cash or accounts payable whenever we purchase under the periodic system. And whenever we make a sale, well, of course, we record the cash that comes in and credit sales revenue, but the inventory related entry that we would make at the time of sale is debit cost of goods sold and credit inventory for the cost of the things that we sold. So anytime we make a sale, anytime we make a purchase, anytime the inventory moves or changes value for whatever reason under the perpetual system, we are debiting or crediting inventory. So we have a running total of how much inventory of specific items we have in stock. And the cost of goods sold gets updated whenever we've sold something. And we'll see that it gets updated in a couple of other specific specialized entries that we'll look at after we get a basis on inventory. Every sale will increase cost of goods sold, debit cost of goods sold, decrease inventory. Of course, what we have going on here is an effect to net income because cost of goods sold appears on the income statement, and an effect to my assets. As we sell the inventory, I have to reduce the amount of inventory that I'm reporting on my balance sheet because I no longer have these items. I sold them to a customer. So to think about these two accounts, cost of goods sold rises and inventory falls. And that starts to become something that we want to think about, is like how the correlation of different accounts, and correlation just means their association. So as one account rises, does another account rise? Or as one account rises, does the other account fall? That starts building a sort of natural accounting intuition, where you can detect errors, you can detect issues with how things are being recorded on a macro level. As we record more cost of goods sold during a period, all things equal, we would expect to have less inventory because of that cost of goods sold, because every dollar of cost of goods sold reduces a dollar of inventory. Under the periodic method, we don't have all of these adjustments ongoing all the time. In fact, even when we purchase something under the periodic system, we don't debit the inventory account. We put it in a separate account called purchases, and we credit cash or accounts payable, depending on whether we paid with cash or we are paying with credit, a promise to pay or credit. So this would be the purchase under the periodic system. And I'll talk more about what purchases is in just a second, but there's no movement to the inventory account. Even at the time of sale, even when I sell something, I record the cash or the account receivable, I credit the sales revenue, but I make no debit to cost of goods sold or credit to inventory at that time. I wait to the end of the period and I make an adjusting entry to determine the cost of goods sold for all of my sales during the entire period at the end of that time period, whether that's a quarter, whether that's a month, whether that's a year. And so the periodic system fails in that we don't get a continuous updating of the inventory account every time I purchase something, every time I sell something, as I do under the perpetual system. It goes into other accounts that are related to the inventory account, for example, purchases. But in the case of sold things, I don't actually update what I've sold. I don't credit inventory until the end of the period. I don't debit cost of goods sold to the end of the period. And so, with that, you can kind of see what I mean about technology sort of paving the way for our ability to use perpetual systems. Because back in the day, before we had scanners at, grocery stores and all that, and computer systems that would log the sale immediately, and even do, if it's connected to its accounting software, as soon as they scan something at the grocery store, like an apple for $1, it will debit cost of goods sold $1, credit inventory -apple for $1. And that all gets logged in right away. There's no need to go into our, storeroom and say, okay, well, we started the day with 400 apples. We ended the day with 200 apples. We purchased 1,000 apples. So how much have we sold? That would be the periodic method. And since now we have an integrated system where it makes the transaction costs of recording each individual sale much lower, companies are more likely to employ perpetual, like I said, especially if they're a low profit margin, high volume sort of sales setup, which means they're making a lot of small sales to make their profit. And again, if a company is making very few sales, but they have a large profit margin on every sale they make, then you could make an argument more for a periodic method. But that doesn't tend to be the business model of a lot of companies. So let's talk more about the perpetual system, the one that you're a little more familiar with, the one that's more popular. It's a simplified system. It appeals to fewer accounts. So all we're doing whenever we're doing perpetual system is always updating the inventory account. So there's no, and you'll see the periodic system doesn't just have purchases, it has 3 other contract adjunct accounts, but we're always debiting or crediting inventory, which is a great advantage just in terms of its simplicity. And also, as I've said before, we have an easy ledger account that is always up to date. The purchases or the production of finished goods are debited into the inventory account, and sales are credited every time they happen. Cost of goods sold is also kept at a running balance. So at any point in time, I know exactly how much I've sold since the last time I closed out cost of goods sold. Because remember, of course, cost of goods sold is a temporary account that gets closed out into retained earnings at the end of any period. And the final advantage is at any point in time when I want to, I can take a physical inventory, and this tends to be done only at a reporting date. And the idea is, if I have this inventory account and I've been continuously updating the account, I have all of my purchases flowing into this side. I have, of course, what I started with. I have all my purchases. I have all of my sold inventory credited. Then I have the ending balance is really an expected amount in storage, if you will. So after I've went through, and we'll just use a grocery store analogy, the food's one of my favorite things. We're like, okay, we should have $1,000 of apples back there in the cooler and the fridge in the back. And we're at the end of the period, I go in there and I take that count and I'm like, whoa, wait a minute. I thought, because according to this inventory, the ending balance should be 1,000, but I'm only counting $940 of apples. So we can take the expected amount, which is from my ending balance of the inventory account, and subtract off the actual physical inventory when I go through and count every single apple I have. And that's just a joy. Ask anyone who's worked where they take an inventory. And then that gives me what we call loss or shrinkage, inventory shrinkage. And basically, this is just an estimate of what amount of inventory was stolen, ruined, lost, whatever, right? So we get an idea of the efficiency with which we're handling our goods. You know, do we have a problem with employee theft? Do we have a problem with customer theft? Do we have a problem just efficiently handling our inventory? Is it spoiling? Is someone breaking it whenever they're trying to shelve it, et cetera? So we get a little bit more of a management hands-on feel when we use a perpetual system. And we'll soon figure out why that is not available under the under the periodic system. So under the periodic system, the cost of all my purchases is recorded in the purchases account, not the inventory account. So we'll look at purchases first, and then we'll add some other accounts to it. But purchases is actually an adjunct inventory account. It's an adjunct asset because it's adjunct to inventory. And this is, you know, the first adjunct asset we're looking at. We've looked at some contra assets. We've looked at, you know, allowance for doubtful accounts, allowance for sales returns, sales discounts, sales returns themselves, but we haven't had an adjunct account yet. And this is one of our first adjunct accounts in this class. So all of my purchases go into this account. Like I said, when I purchase something, I debit purchases and I credit whatever means of payment the company uses. And as it is an adjunct account, right, it follows the rules of its parent account. Before, the contra accounts, their rules were flipped. If I debited the parent account to increase it, I would credit the contra account to increase it. But here, because it's adjunct, it follows the rules of the asset account that it's tied to, and we increase it with debits. Now, this thing is a nominal account. It will be closed when cost of goods sold is recorded at the end of the period. Remember, I told you that, you know, cost of goods sold under the periodic system is not evaluated at the point of every sale. We wait until the end of the period to make an adjustment to inventory, showing the amount of goods that we have still after all our sales. And we also wait until the end of the period to record the total cost of goods sold for the period. At the end of the period, the periodic system absolutely relies on the fact that we're going to do a physical count. And from that physical count, we're getting our ending inventory. And now think about for a moment how this is very different than what we just talked about, where under the periodic system, I had an expectation of what I should find in my ending inventory because I was tracking all the purchases and all the sales in the inventory account over time. I had that expectation. I did a physical count to just check that expectation. And if I came up short, well, then I had shrinkage. It must have been stolen. It must have been ruined somehow. Perhaps it's spoiled. When I'm working under the periodic system, because I keep no record of the cost of the units sold, I don't update any of my inventory accounts with a credit. I don't even update the purchases account with a credit. So I have no idea. I have no expectation of what my inventory is going to be. I have to go and take account to get ending inventory. And I assume, and this is a big assumption, that this count is correct. So why that has to be a big assumption is that when you're doing a periodic system, the only way you can deduce cost of goods sold is by using what we call the inventory equation, which simply states that beginning inventory plus my net purchases for the period. We'll talk about what net purchases are here over to the side in a moment. I basically have the truth that, well, I began with an amount of inventory and now I basically purchased a net amount. Maybe I returned some, maybe I got a discount. Well, what's the dollar value of everything I purchased? Then that gives me what something called goods available for sale, which is pretty on the nose in terms of a description. Everything I had when I started that period, plus everything I bought, is the stuff I have available for people to buy from me. Now, when I take that ending inventory account, take that ending inventory count, I subtract off my ending inventory count. And that's what gives me cost of goods sold under the periodic system. So basically, I look at everything I had available to sell. And if I had $1 million of inventory available for sale and I go and do my physical count and I only have $1 remaining, then I must have sold $999,999. That's the presumption. That's the big assumption of this method. Now, is that assumption true? No, it doesn't need to be true, because if I'm just going in and counting and assuming anything that isn't still there must have been sold, then if someone steals something from me, it's not going to be there, but I didn't sell it. If someone breaks a piece of inventory when they're unloading it or putting it on the shelf, it's not going to be in my ending inventory account, and it's therefore going to be counted as if it were sold under the periodic method, but it has not been sold. And so that's a big problem with the periodic system. You cannot deduce any shrinkage because of this assumption. You cannot deduce shrinkage like you can under the periodic system. I'm sorry, perpetual. Sorry, they both begin with P's, P-E-R in fact. But hopefully I'll catch myself whenever I slip. And what is net purchases? Well, the problem is net purchases begins with or brings out a whole new host of accounts that we have to track. And these are only accounts that arise in a periodic system. We have our purchases account. That's that adjunct account that I talked about up here. But we also have purchase discounts. This is a contra account. We have freight in. So any cost of the inventory coming in is added to my overall inventory amount. And then I have a contra account that tracks all of my returns that I make. Now, under the periodic system, a lot of accounts, different contras, different adjuncts. I'll write them down here just to give you a sense of them all. There's 2 adjunct accounts that separately track, okay, this is just the invoice price of my purchase. Well, then I have a different account that tracks how much on top of the invoice price did I pay to get it to my place of business. These are both adjunct accounts. They both increase the value of my inventory. They're also both nominal accounts that are closed whenever I record cost of goods sold at the end of the period. I also have purchase returns and purchase discounts. These are both contra asset accounts, because if I get a discount, if I take a discount on inventory that I'm purchasing, then it reduces the overall cost of my inventory. And if I return any inventory that I purchased, well, then I don't have it in my place of business any longer. It's going back to the person I bought it from. Therefore, it should also reduce my overall inventory. And just to reiterate, all 4 are closed when cost of goods sold and inventory are updated at the end of the period. So a lot of stuff going on with the periodic system. It's a little overly complex, and used to be a good way of sort of dividing up the different aspects of our inventory system prior to our ability to process data and store it and call upon it very seamlessly with technology. So like I said, this is not likely to be used except in very particular circumstances, and Perpetual is much more likely to be used by companies that are existing and operating in the modern world. But still, there are some smaller companies or, like I said, low sales volume, high margin companies that might use this. How does this translate into the Perpetual system? Very easily. When I purchase something, I debit inventory. When there's additional freight costs, I debit inventory. When I return something, I credit inventory. And when I take a discount on a good that I purchased, I credit inventory. So the Perpetual system replaces all of these accounts with direct debits and credits to inventory. We do not use the middleman contra account system under the Perpetual system. Okay.